Are you struggling to pass the CPA exam? Did your review course fail to fit your learning style? I'm Darius Clark of I-75 CPA Review, the #1 course supplement, where the right teacher makes all the difference. All right, let's look at temporary differences that relate to income. There's only two possible situations. You could have a temporary difference that results in book income this year, taxable income next year. An example of that would be the installment method. Or you could have an example of taxable income this year, book income next year. And you'd have that if you collected cash in advance and performed the services later. So we'll start with the installment method, where it's book income this year, taxable income next year. We got Power Inc. began operations January 1st, year 3. What do they want to know? They want the current income tax expense for year 3. So not deferred yet. Let's remember what the current income tax expense is all about. We got to get this year's taxable income times this year's tax rate. So Power began this year, and they recognize revenue from all sales under the accrual method. However, in the tax return, they report certain sales under the installment method. And here's the gross profit on installment sales under each method. So on the financial statements, they used accrual accounting. And in year 3, picked up $1.6 million. So book income in year 3, $1.6 million. Taxable income in year 3 was based on the installment method, and taxable income, they tell us, was $600,000. So how much is current income tax expense for year 3? That's just a matter of multiplying current year taxable income of $600,000 times 30%. And when you do that, that's $180,000, which is choice C. And the journal entry would be a debit to income tax expense current and a credit to cash or income tax payable current. Notice we didn't need year 4 to answer this question because it only asked us about year 3, and it only asked us for the current expense in year 3, not even deferred. Now this question is based on the same facts, but they want to know what amount should Power report as deferred income tax asset or liability for December 31st, year 3. So still only year 3 matters, and looks like we haven't collected yet $1 million from what we earned of $1.6 million to what we reported on the tax return, $600,000. There's a temporary difference out there at the end of year 3 for $1 million. And if 30% is the tax rate for both years, then we're going to multiply to get our deferred income tax liability 30% of $1 million, or $300,000. The answer is B. And the all-important journal entry to make here for deferred income tax for year 3 would be a debit to income tax expense deferred, $300,000, and credit income tax payable deferred, $300,000. So B is correct. We need a deferred tax liability of $300,000. It's reported as a DTL since taxable income will be higher than book income next year when the $1 million is collected. We earned it this year, but we're going to pay the tax on it next year. So our T account for deferred tax liability at the end of year 3 is $300,000 ending balance. I want you to make a T account for deferred tax liability. I want you to start with 0 because this is the first year, and then put $300,000 in because we just made a credit, and that's going to be the ending balance at 12/31 year 3. And funny thing about ending balances to liabilities, they become the beginning balance next year. We didn't have a beginning balance in year 3 because they told us year 3 was the first year of operations. But we are going to have a beginning balance in this deferred tax liability on 1/1 year 4. This account is going to keep going. So make a T account for it. Okay, so now the question with the same facts wants to know, if the tax rate's 30% for both years, how much total income tax expense on the income statement for year 3? And when you say total income tax expense, we mean the deferred and the current. And we just did the deferred, it was $300,000. How much was the current income tax expense for this year? Well, that was just the taxable income for this year, $600,000, times the 30% rate, or $180. So the answer to total income tax expense on the income statement for year 3 is $480,000. And that's letter D. The journal entries for year 3, we made both of these. We'll debit income tax expense current and credit cash or income tax payable current for $180. And then for the deferred, we said we're going to debit income tax expense deferred, $300,000, and credit income tax payable deferred, $300,000, and that's the total of $480. So if they ask for the total expense, You want the current and the deferred. In this case, you'd add them both together. In year 3, we paid only $180,000, but we expensed $480,000. And in the year of a DTL, you'll always expense more than you pay. You'll have more expense on the income statement than the amount paid in taxes, and that's because book income is higher than taxable income. And that's what caused this DTL. We had book income of $1.6 million, but we only had taxable income of $600,000. Also keep in mind the DTL has a balance going into year 4 of $300,000. Keep that T account handy because now we're going to go into year 4. Your T account for deferred tax liability should look like this right now, with a $300,000 ending balance at 12/31 year 3, which is going to become the beginning balance of 1/1 year 4. Now with the same facts, we're on to year 4. Assuming an income tax rate of 30% for both years, how much is current income tax liability for year 4? So current income tax liability for year 4, what's owed at the end of year 4 currently? That's based on year 4's taxable income, which they tell us is $1.4 million. So $1.4 million times 30%, you owe $420,000 right now. And that's choice A. So you would debit income tax expense current for $420,000 and credit cash or income tax payable current $420,000. If you credited income tax payable instead of cash, then very soon you're going to get around to paying that liability, and then you'll just reverse it. You'll debit income tax payable current $420 and credit cash. If you credit cash right now, that means you're paying it today. But the key is this is current income tax liability. It's what's owed very soon, right now, within the next 30, 60, 90 days. It's not the deferred portion. We'll get to that next. All right, same facts. Now they want to know what amount should they report as deferred income tax asset or liability at December 31st, year 4. So at the end of year 4, how much is still yet to be collected? Looks like there's still $1 million out there from year 3 sales, and there's also $1.2 million still hasn't been collected yet from year 4's installment sales, because we picked up $2.6 million on the books. $1.4 million is all we're picking up for the tax return. So add those two amounts together to determine what's still owed in taxes. We got $1 million from year 3 and $1.2 million from year 4. So $2.2 million is still outstanding, waiting to be collected, and when we get it, we're going to pay 30% tax on it. So right now it's owed. So we have deferred tax liability for $660,000. And that's letter B. We have a $660,000 deferred tax liability. Now for the journal entry. You might think we're going to debit income tax expense deferred and credit income tax liability deferred for $660,000, but why is it only $360,000? Remember that T account. It's going to have a beginning balance of $300,000 for deferred tax liability, and then we're going to put the ending balance in there. That's the $660,000 that we just calculated. So we calculate the ending balance, and then we back into this year's adjustment. So this year's adjustment is only $360,000 debit to deferred tax expense, not $660,000. We need to get to the $660,000 balance of the deferred tax liability account. We want to get to this ending balance of $660,000 where we had a beginning balance of $300,000, so we have to credit deferred tax liability for only $360,000, and that forces us to debit deferred tax expense for $360,000. And that's why the entry we made is this one. Debit income tax expense deferred, $360,000, and credit income tax liability deferred, $360,000. And if you found this video helpful on income tax expense, let me know in the comments section. And if you need more help with deferred taxes or any part of the CPA FAR exam, go to CPAExamTutoring.com and get yourself on I-75, where the right teacher makes all the difference.